All right, let's get right into it. Today we're going to unpack a really surprising link: how economic moves made in Japan could actually send the price of Bitcoin tumbling.
I mean, on the surface, they seem like two totally different universes, right? You've got the Bank of Japan, this super traditional central bank running one of the world's biggest economies.
And then you have Bitcoin, the digital currency that's supposed to be completely separate from all these government systems. Well, it turns out they're way more connected than you might think. In fact, some of the top macro analysts out there are saying that a major policy change in Japan could be the one thing that knocks Bitcoin's price back below that critical $70,000 level. So, how on earth is that possible? It all boils down to what you could call a Japanese ripple effect. You see, even though we think of crypto as decentralized, the reality is it's now woven into the fabric of the global economy. And that means it gets pushed around by the same massive forces that move money across the planet. And right now, the Bank of Japan is a huge player on that stage. Now, to really understand what's going on, we need a super quick crash course on two terms you hear all the time in finance: hawks and doves. Okay, so a hawkish policy is all about fighting inflation. Think of a hawk. It's aggressive. A central bank acts hawkish when it raises interest rates, which tightens up the money supply and makes borrowing more expensive. A dovish policy is the complete opposite. It's gentle, designed to boost growth by lowering interest rates and making money cheap and easy to borrow. And you have to understand, for decades, the Bank of Japan has been the most famous and most extreme dove in the entire world. And all that incredibly cheap Japanese money, well, it didn't just stay in Japan. It actually fueled this massive global financial engine that's been running on full blast for years. It's a strategy called the Japanese yen carry trade. And what it is investors, big ones, borrowing enormous amounts of Japanese yen at those practically 0% interest rates, and then taking that money and investing it all over the world in things that offer much higher returns. The whole thing is actually pretty simple. Step 1, borrow Japanese yen for next to nothing. Step 2, take that cheap cash and plow it into assets that pay you more, like US stocks, bonds, or even crypto. And step 3, you just pocket the difference, which in the finance world is called the carry. This one trade has pumped trillions of dollars of easy money into markets all over the globe. So this has been the status quo for a very long time. But what happens when that fire hose of cheap money finally gets turned off? Well, that's exactly where Bitcoin starts to feel the pinch, and this whole system begins to unwind. The second the Bank of Japan flips from being dovish to hawkish, the second they raise interest rates, that whole carry trade just isn't profitable anymore. The free money party comes to a screeching halt. So what do investors have to do? They have to unwind their positions. That means they have to sell off all those global assets, stocks, bonds, and you guessed it, crypto, to get cash, trade it back into yen, and pay back their loans that are suddenly getting more expensive. This process literally sucks a huge amount of cash, or liquidity, right out of the world's markets. And this gets us to a really important point about how Bitcoin actually behaves in the market. Over the last few years, it's pretty much acted like a risk asset. What that means is its price goes up when there's lots of cheap money sloshing around and investors are feeling bold. But when that money tightens up, these risk-on assets are usually the very first things people sell. And hey, don't just take my word for it. This isn't just some theory. The top macro analysts are drawing a direct line between these two things. The consensus is pretty clear. The Bank of Japan getting hawkish is a major problem for risk assets, and a drop below 70K for Bitcoin would be a direct consequence of this global shift in money. Okay, so that's the story for the price in the short term. But it is absolutely crucial to separate that from the bigger picture. Because while the price might get knocked around by these global money flows, the story of the underlying technology is something else entirely. This is probably one of the most important distinctions you have to make in the crypto space if you want to understand the long game. We have to separate the price of the asset, which can be super speculative, from the actual value of the technology it's built on. So here's the best way to think about it. On one side, you have Bitcoin's price. It's acting like a risk asset, very sensitive to all this global liquidity we've been talking about. But on the other side, you have the value of blockchain itself. That's a technology asset. Its value is foundational and comes from making businesses run better. And here's the key takeaway. While the yen carry trade unwinding can shake up Bitcoin's price, it doesn't really change the fundamental value of the technology. The real-world use of blockchain for stuff like making supply chains transparent or managing data securely, that stuff just keeps on growing. that value isn't tied to whether interest rates in Japan are at 0% or 1%.
Which leaves us with a really fascinating question to chew on. We started this whole conversation with the idea that crypto is separate from all this traditional finance stuff. But if a central bank's policy on the other side of the world can affect it so directly, it really makes you rethink what decentralization truly means in a world that's this interconnected.